So picture this. You're sitting at your kitchen table, maybe it's a Sunday morning. You've got your coffee going, and you're doing that thing where you're kind of half reading the news, half staring into the middle distance, wondering if you're making the right financial decisions. The market went up last week, but your buddy told you it's about to crash, your mortgage rate is still high, groceries somehow cost more than they did 6 months ago, and somewhere in the back of your mind there's this low-level hum, this quiet, persistent anxiety that says, am I missing something? Is there something everyone else knows that I don't? And then you see a headline. Goldman Sachs, one of the most powerful financial institutions on the planet, releases their economic outlook for 2026. And it's mostly optimistic, like weirdly, almost suspiciously optimistic. No recession, soft landing achieved, inflation cooling, GDP growing, everything's fine, apparently. But here's the thing. I've spent a lot of time, probably too much time, honestly, learning how to read what institutions like Goldman Sachs are actually saying versus what they appear to be saying on the surface. My name is Nick, and I basically live in the intersection between financial data, human psychology, and the question of why the headlines almost never tell you the whole story. I'm obsessed with the gap between what the numbers say and what they mean for regular people trying to build something real. And when I read Goldman's 2026 outlook, I didn't just read the optimistic parts, I read the footnotes, the caveats, the quiet little warnings tucked between the good news. Because here's what I've come to believe after years of doing this. The most important message in any major financial report is almost never the headline. It's the stuff they say carefully, diplomatically, with just enough hedging that if things go sideways, they can point back and say, well, we did mention that. So that's what we're going to do today. We're going to decode Goldman's hidden message about 2026, not to scare you, not to send you into a doom spiral, but to actually help you understand what's coming and, more importantly, what to do about it. Because the people who navigate economic shifts well aren't the ones who got lucky, they're the ones who read the room before everyone else did. Let's get into it. Okay, so the headline from Goldman's 2026 outlook is essentially this: the soft landing worked. The Federal Reserve raised interest rates aggressively to fight inflation, and instead of tipping the economy into a full recession, which honestly most economists were quietly terrified would happen, the economy kind of held together. Inflation came down, employment stayed relatively strong, consumer spending didn't collapse, and Goldman is projecting that in 2026, the U.S. economy grows at around 2.5%, inflation settles close to the Fed's 2% target, and the unemployment rate stays relatively contained. On the surface, that sounds great. That sounds like we won. But here's where I want to slow down, because there's a version of fine that feels really different depending on where you're standing. Like macroeconomic stability and individual financial stability are not the same thing, and I think a lot of people feel that disconnect viscerally right now. The economy is technically healthy, but a huge portion of people are not feeling healthy. They're carrying credit card balances at 22% interest, they can't afford a down payment, their wages went up but not as fast as everything else did over the last 4 years. Goldman knows this, and if you read carefully, they acknowledge what economists call the K-shaped recovery, this idea that the economy doesn't recover evenly. Some people shoot up, some people fall further behind, the letter K, two lines going in opposite directions at the same time. The takeaway here isn't panic, it's clarity. If the macro environment is stabilizing, that actually creates opportunity, but only for people who understand the landscape. The mistake is assuming a good economy automatically means things get easier for you personally. It doesn't. You have to be intentional. You have to know which side of that K you want to be on and actually move toward it. Here's where it gets interesting. Goldman's outlook includes projections about Federal Reserve rate cuts in 2026, and this is probably the single most misunderstood part of the whole report. A lot of people hear rate cuts and immediately think, great, things are getting cheaper, time to refinance, time to buy a house, time to borrow. And there's some truth to that, but the full picture is more nuanced, and honestly, the nuance matters a lot here. Rate cuts happen for two very different reasons. The first reason is celebratory. The Fed cuts because inflation is truly under control and the economy is humming, so they're easing the pressure because they don't need it anymore. The second reason is defensive. The Fed cuts because something is starting to wobble and they need to stimulate growth before things slow down too much. Goldman's projections sit somewhere between these two, but it leans towards the first. They're not projecting emergency cuts, they're projecting gradual, measured reductions, which sounds reassuring.
But they're also doing something subtle. They keep flagging upside inflation risks, which is their careful professional way of saying, we could be wrong, and if inflation reaccelerates, the cuts might not happen or they might reverse. Think of it like this. Imagine you've been running a fever for 2 years. The doctor says your temperature is finally coming down. Great news. But they also say, make sure you rest, don't overdo it, because if you push too hard too soon, the fever could spike again. That's basically what Goldman is saying about inflation and rate cuts. We're getting better, but we're not all the way there. And the worst thing we could do is assume we're fully healed. For you personally, this matters enormously. If you're sitting on a variable rate loan waiting to refinance, understand that the timeline is uncertain. If you're planning a major purchase that depends on significantly lower rates, build in flexibility. And if you're an investor, understand that the sectors that benefit from rate cuts, real estate, smaller cap growth stocks, bonds, are already starting to price in those cuts, which means the easy money in anticipating them may already be gone. Goldman's report paints a fairly stable picture of the labor market heading into 2026. Unemployment stays low, wage growth moderates but doesn't collapse, the job market basically holds. But buried in there, and this is one of those things you have to read slowly, is a warning about what they call labor market normalization, which is a very elegant, very composed way of describing something that could feel pretty uncomfortable if it affects you directly. Here's what that actually means. During the pandemic and the years right after, we had this bizarre situation where there were more job openings than people to fill them. Employers were desperate, workers had leverage, wages got bid up, people were switching jobs and getting 20–30% raises just by walking across the street to a competitor. That era is basically over. Goldman's data suggests that the balance of power in the labor market is shifting back toward employers. Job openings are declining, quit rates are dropping, meaning fewer people feel confident enough to voluntarily leave their jobs. Wage growth is slowing. And in certain sectors, particularly in tech and finance and some parts of media, we're already seeing layoffs and restructuring. Now, Goldman frames this as a healthy normalization, and in macroeconomic terms, they're not wrong. Runaway wage growth does feed inflation, so cooling it is part of the plan. But normalization for an institution is my raise disappeared for a person, and I think it's worth being direct about that. The actionable piece here? If you've been coasting on the leverage of the last few years, if you haven't been upskilling, if you've been meaning to make yourself harder to replace, but haven't quite gotten around to it, 2026 is probably the year that catches up with you if you don't address it. The people who thrive in a normalizing labor market are the ones who made themselves genuinely valuable, not just conveniently necessary because everyone was hiring. Okay. I want to talk about something that Goldman addresses almost apologetically in their report, like a doctor bringing up a test result they really wish they didn't have to. American consumer credit. Here's the situation. During the pandemic, consumers built up enormous savings. Stimulus checks, reduced spending, people stuck at home not spending money on things. And then, as the world reopened, people spent that savings enthusiastically, aggressively, sometimes recklessly. That savings buffer is now largely gone for lower and middle-income households. And in its place, debt. Credit card balances in the United States hit record highs. Buy now, pay later usage exploded. Auto loan delinquencies are creeping up. And this is happening at a time when interest rates on consumer debt are historically high. Goldman flags this as a risk, specifically as a risk to consumer spending, which drives about 70% of the American economy. Their base case is that this doesn't become a crisis, but their language around it is careful, very careful. The kind of careful that suggests they're not entirely sure they're right. And look, I'll be real with you. This is one of those things where the macro picture and the individual picture diverge most sharply. Goldman's saying the aggregate consumer is probably okay, but the aggregate consumer is a statistical construct. It's an average, and the average is being pulled up significantly by high-income households that are doing very well right now, partly because they own assets, stocks, real estate, that have appreciated substantially. If you're not in that group, the average doesn't describe your experience at all. So here's the thing I'd encourage you to genuinely sit with. How is your personal balance sheet looking heading into 2026? Not the country's balance sheet, yours. Because the macro environment might be stable while your personal financial situation is quietly fragile. And the time to address fragility is before the stress test hits, not during it.
Now, I want to spend a minute on something Goldman buries in their risk section. And buries isn't quite fair. They do address it, but it's definitely not the headline, and that's geopolitical and trade risk. Goldman's base case for 2026 assumes a relatively stable global trade environment, but their risk scenarios, the what if we're wrong part of the report, are pretty heavily weighted toward trade disruption, tariffs, sanctions, supply chain fragmentation, the broader deglobalization trend that's been building for years and keeps accelerating. Here's a metaphor that might help. Think of global trade as a massive, intricate plumbing system. For decades, we built it to be maximally efficient, pipes running everywhere, tightly connected, optimized for flow. And that efficiency was incredible. It's why you can buy a cheap smartphone and affordable clothes and inexpensive electronics. But tightly connected systems that are optimized for efficiency are also brittle. When one pipe breaks, the disruption travels fast and far. And right now, there are a lot of pipes under stress. The relationship between the US and China, European energy dependencies, semiconductor supply chains, food and agricultural trade routes. Goldman doesn't think any of these become catastrophic in 2026, but they acknowledge, diplomatically, that the probability of a disruptive surprise is higher than it used to be. And that means inflation could re-accelerate in unexpected ways. It means certain industries could face sudden headwinds. It means the stable, predictable macroeconomic path they're projecting is more dependent on things going right geopolitically than it might appear. For most of us, this translates into a simple principle. Don't build a financial plan that only works if nothing goes wrong. Build one that can absorb a shock. Here's one of the most genuinely strange things about Goldman's 2026 outlook, and honestly, when I first read this section, I had to put it down and think for a minute. They're projecting continued, albeit slower, growth in equity markets, stocks going up, and simultaneously they're flagging that valuations, the price you pay for each dollar of earnings, are historically elevated, like in the top percentile of historical ranges for certain indices. Those two things existing in the same report, stocks are probably going up, and stocks are objectively expensive, represents a tension that I think a lot of people instinctively feel but struggle to articulate. What Goldman is essentially saying is this: the fundamentals, earnings growth, economic expansion, corporate profitability, are solid enough to justify continued investment, but the price you're paying for those fundamentals is high, which means the margin for error is thin. If earnings disappoint, if growth slows unexpectedly, the market doesn't just drift down a little, it re-rates, quickly, significantly. This isn't a prediction that the market crashes. It's more like, if you buy a house in a neighborhood that's been getting more expensive for years, the house might still be a fine place to live, but if you paid a premium and the neighborhood softens even a little, you're underwater before you expect it to be.
The practical implication, and Goldman sort of implies this without saying it quite so bluntly, is that 2026 is a year where diversification matters more than usual, where the difference between a concentrated bet on a single theme and a genuinely diversified portfolio could be enormous, where having some dry powder, some cash, some flexibility gives you options that a fully deployed investor doesn't have. I want to talk about housing for a second, because Goldman's treatment of real estate in 2026 is, I don't know, kind of quietly devastating in its honesty. Their projection is basically that housing affordability stays really, really bad. Not dramatically worse than today, but not meaningfully better either. The combination of home prices that shot up 40% between 2020 and 2023 and mortgage rates that are still significantly higher than their historical lows creates what economists call an affordability lock, and Goldman doesn't see that resolving quickly. The mechanics are almost cruel. People who bought homes at 3% interest rates in 2020 and 2021 are essentially locked in. They're not selling, because selling means giving up that rate and buying something new at 6 or 7%. So inventory stays low, and because inventory stays low, prices stay elevated even as rates are high, which is this bizarre economic inversion that defies the normal logic where higher rates cool prices. Goldman projects modest price appreciation in 2026 in some markets, modest depreciation in others, with the broader story being stagnation, an expensive, illiquid market that isn't crashing but isn't becoming accessible either. For younger people trying to enter the housing market, this is genuinely discouraging information, and I don't want to dress it up as something other than what it is, but there are a few things worth noting. 1. Regional variation is huge. Goldman's national numbers mask markets where affordability is actually improving meaningfully. 2. The rent versus buy calculation has shifted, and in many cities, renting and investing the difference is genuinely competitive with buying, maybe more so than it's been in decades. 3. Waiting for the perfect moment to buy has historically been costly, but so has buying purely out of anxiety that you're being left behind. The honest answer here is that housing in 2026 requires more nuanced thinking than the housing market has demanded of people in a long time. Okay, so we've talked a lot about risks and complications and the gap between the headline and the fine print, and I want to make sure we don't leave it there because Goldman's report, honestly, contains a genuine reason for optimism if you know where to look. The AI and productivity story is real, like it's easy to be cynical about it because there's been so much hype, and a lot of that hype is genuinely deserved skepticism. But Goldman's economic research team is fairly rigorous about this, and their data suggests that AI-driven productivity gains are beginning to show up in measurable ways in certain industries: technology, financial services, healthcare administration, legal research. Not everywhere, not uniformly, but the signal is there. And historically, periods of genuine technological productivity improvement have been associated with real, lasting increases in living standards. Not immediately, not painlessly. There's always disruption and transition, and people whose specific skills become less valuable while others become more valuable. But the arc eventually bends toward broader prosperity. Goldman projects that by the back half of the 2020s, productivity growth could be meaningfully higher than it's been in the last 2 decades, which, if they're right, translates eventually to stronger wage growth, better corporate margins, more sustainable economic expansion. The question for you individually is, are you positioning yourself to participate in that upside? Because the productivity revolution doesn't just reward companies, it rewards people who understand how to use new tools, who are curious about how their industry is changing, who invest in their own adaptability. It punishes people who assume their current skill set is permanent. This is maybe the most genuinely hopeful and genuinely urgent thing in Goldman's whole report, dressed up in the language of GDP projections and total factor productivity, but underneath it, it's basically saying, the people who lean into change in the next few years are going to be in an incredibly strong position, and the people who resist it are going to find the ground shifting under them. So let's take a step back and look at the full picture, because I think if you've been with me this whole way, you deserve a clean synthesis of what we've actually decoded here. Goldman Sachs' headline for 2026 is optimistic. Soft landing achieved, moderate growth, inflation fading. And honestly, at the macro level, that's probably roughly right. The economy isn't collapsing. The apocalyptic predictions that were floating around for the last couple of years mostly didn't come true. But underneath that headline is a more complicated, more honest story. A K-shaped economy where stability at the aggregate level masks divergence at the individual level. A labor market that's cooling in ways that will surprise people who've been operating with pandemic-era leverage. A consumer credit situation that's fragile in pockets. Geopolitical risks that could disrupt the whole narrative. Asset markets that are priced for perfection in a world that rarely delivers it. A housing market that remains genuinely inaccessible for a generation of younger buyers, and a technological productivity revolution that is creating enormous opportunity but distributing it unevenly. If I had to distill all of it into one idea, it would be this: 2026 is not a year to be passive. It's not a year to assume that the economy is fine means your finances will be fine by default. The people who come out of this period ahead, whether it plays out the way Goldman projects or not, are going to be the ones who understood the environment clearly enough to make intentional decisions, rather than just reacting to whatever happened. That means looking honestly at your personal balance sheet. It means thinking seriously about your skills and your relevance in a changing labor market. It means not assuming the rate cut you've been waiting for is coming on your preferred timeline. It means building financial resilience, not because catastrophe is certain, but because flexibility is always valuable. There's a version of this economic moment where you look back from a few years out and say, that was actually a really good window. The macro was stable enough to take calculated risks. The opportunities were there for people who were paying attention. And there's another version where you look back and wish you'd taken it more seriously. Goldman is telling us, in that careful, professional, just hedged enough way of theirs, that the window is open. What you do with that is up to you. Thanks for watching. If this helped you see the picture a little more clearly, that's exactly what we're here for.